In this episode, I'll discuss how the interest rate environment affects your infinite banking policies. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, everyone, welcome back to the show. It's so awesome to have you here. Just wanted to reiterate, by the way, in all of these episodes that we do, the main point of this show is to help you do infinite banking better and to understand it more deeply. And so my whole goal with every episode is how can either on a practical side, how can infinite banking be done better in people's lives? And I think we do one of the best jobs in the entire infinite banking community at teaching some more in-depth concepts of infinite banking. On top of that, just understanding it more deeply on a theoretical level, practical level, philosophical level, just understand the impact infinite banking can have. And that's our whole goal in every episode. And that's what I wanted to dive into today, is more of like understanding how the world around us impacts infinite banking, especially as the interest rate environment is going through some chaos. And so before I dive in, I just want to let you know, man, it's so great to have you. And, we love every single listener we've ever gotten. And if this show is impacting you, it's helping you understand infinite banking more deeply and understand how to practice it at a better, more advanced level, then it would mean the world to us if you guys would leave a review, comment on YouTube, like the show, subscribe, leave a podcast review on Apple Podcasts or Spotify. It would mean the world. Well, let's go ahead and dive in. Today, we want to talk about the interest rate environment at large and how it affects infinite banking policies. And this is a question I think a lot of people will have. Many times they've been voiced to us. And whether you're in a low interest rate environment, people will ask questions, and they're a little bit different than the questions you get whenever we're in a high interest rate environment. So I want to play that out today. So for years, when I first got into this industry and learned about infinite banking was 2012. And in 2012, we were, deep into quantitative easing. We'd been, experiencing quantitative easing for a few years at that point. We're just getting out of the recession. And so interest rates were artificially low, and interest rates were the lowest they pretty much had ever been, just to try to help the economy get, stirred back up and, launched after the Great Recession. And by the way, as we all know, they remained low for a long time. I mean, they just before COVID hit, you could see them, in 2019, they were starting to inch back up. But as soon as COVID hit, that was just another reason to dramatically drop interest rates. So pretty much from about 2009, 2010, all the way until 2022. So we're talking 12, 13 years. Interest rates were at the lowest they'd ever been. And a lot of times the questions we would get from clients were more on the lines of, okay, we're in this low interest rate environment. There's money to be had from banks that is really cheap. And so you hear about the infinite banking, this whole becoming your own banker idea, and you think that one of the best things about infinite banking is that you don't have to go borrow money from banks. You can borrow money from your own policy, pay your own policy back kind of on your own terms. But then they're like, well, the policy has this loan rate, and let's say it's 5%. But I can get like a 2% car loan at the bank. I get 1% financing at an auto dealership or something like that. They're like, why would I ever use my policy to use it? And then because of that, they then start to think, well, maybe this thing doesn't even work. Like what they're saying sounds good, but is it actually practical? I'm going to dive into that just one second. But before I do, I'm going to transition to where we are right now. Now it's a little bit different. Now you're getting different kinds of questions. So at this point in time, using a policy loan in the 5.5% range is some of the cheapest money you can find. That's not the way it was when I first got into the industry. But now you'll start to see, the ability to get policy loans is cheaper than everywhere else, where you can go get a mortgage at 8%. You got car loans are 6, 7, 8%. And so now using your policy is actually offering interest savings in the higher interest rate environment. But you get a different question now, which is, well, now banks are paying us interest on savings accounts and CD accounts. Like I can get real interest at banks. So if you can see the difference here with the interest rate environment is back when interest rates were very low for a very long period of time, people had some questions about whether it ever made sense to do infinite banking because loan rates were higher than you could get for mortgages and car loans and different things elsewhere. And when interest rates are low, loan rates are low, but also bank accounts pay practically nothing. I mean, bank accounts were essentially at zero for 12 or 13 years. Please don't forget that. And then on the flip side, now that we're in a high interest rate environment, now people are saying, yeah, having policies, being able to borrow money against these policies at very low rates is awesome because I can't get these rates anywhere else. But people are starting to question, like, well, now I can get money from banks we have to marry these two ideas. And the easiest way to understand why infinite banking works in low interest rate environments, why it works in high interest rate environments, is to understand exactly how the interest rate environment affects infinite banking policies. And so the reality is, in times of high interest rates, oftentimes you'll see dividends higher than in times of low interest rates. So picture this: the insurance company receives your premium dollars and they have to go put the money to work to one day pay you the death benefit. And so in times of higher interest rates, of course, the insurance company is making more money when they put our money to work. So the insurance companies will be more profitable. Like if you look back in the 80s and 90s and early 2000s, when interest rates were much higher, you had insurance companies paying much bigger dividends back then than you do today. The policies themselves weren't changing. It was just the dividends were way higher. Their profits were way larger. And so in times of high interest rates, you typically expect dividends to go up, but policy loan rates as well will follow. So normally as interest rates go up, dividends start to increase, and the policy loan rate will also increase because typically the policy loan rate is tied to a bond index, like Moody's Corporate Bond Yield Average. But here's where it gets a little bit confusing and how it affects you, is that the insurance company for the last 13 years has been taking our premium dollars and our cash values that are accumulating and investing them in low interest rate debt because that's what was available to them. When the interest rate market starts to shift the way it has and interest rates start to go up in a really, really quick fashion overall, like in 12 months, going from practically 0 to 5%, that doesn't mean that all the bonds and other types of investments that they've made over the last 13 years automatically start receiving the new interest rates. The new interest rates are only taking effect in new investments that they're making. So they may hold all these longer dated securities from 2012, 2015, 2018 that are paying lower rates. And that's this multi-billion-dollar entity with billions and billions of dollars of invested money. Most of it is still at the prior interest rate environment. So essentially what you'll see here is there's always a lag time with dividends. So as interest rates go up, it's good news for us policyholders. We're going to start making more money, but it's not overnight. It doesn't happen like a bank. It doesn't happen like, it doesn't happen in an overnight, like you would with a savings account, which can go from 0% to 5% in 1 year based on interest rates alone. That's not how it works inside the insurance company. You might see marginal increases momentarily. We just actually got a notice from one of the insurance companies that they're slightly improving their dividend scale for next year. And the other one is saying it's going to stay the same for next year. But if interest rates stay at this elevated space that they're in, it's likely we'll see an increase in dividends next year. And essentially all that they're trying to say is, we are excited for this new era of higher interest rates. Sure, it does mean that policy loan rates will likely increase slightly, but that does also mean that dividends will follow suit. So as loan rates go up, typically dividends go up, but they're not tied to the same thing. The loan rate is tied directly to the Moody's Corporate Bond Yield Average, whereas dividends are tied to actual profitability of the insurance company, which is going to take some time to replace the old low interest rate bonds with the new higher interest rate bonds. But once that takes place, you'll start to experiencing higher and higher dividends. But it's all relative is what I'm trying to say. Infinite banking works the same, whether it's in low interest rate timeframes or high interest rate timeframes overall. Because if you go back to the time when Nelson Nash wrote his book, which was the year 2000, interest rates were much higher. And so dividends were much higher in Nelson's book than we're experiencing today. That doesn't mean that we'll never get back there, but that doesn't just mean it's an obvious good thing. Because of course, if dividends go back to the 7-8% range that they would have been in the 90s and early 2000s, policy loan rates were also at 7 or 8%. So at the end of the day, the interest rate environment affects you in both ways, and the same thing goes with everything. On top of that, you could say, well, dividends were much higher back then, but you could get a 5% CD like you could today back then as well. So it's all relative. In times of lower interest rates, it's true that the policy dividends are not as high because the insurance companies aren't making as much money, but the policy loan rates are going to be lower. And on top of that, you're comparing becoming your own banker using policies to what you could do elsewhere in like a savings or checking account or a regular banking function. So in times of low interest rates, sometimes it's actually even more noticeable how powerful IBC is whenever banks are paying 1% and you're making like 5% inside of a policy. Like it's a gigantic difference. That might be different than you can get 5% in a bank and 7 or 8% in a policy. So all that to say, there's always a lag time, whether interest rates are going up or interest rates are going down, how it'll affect dividends. But nonetheless, at the end of the day, the process of becoming your own banker over a period of time is pretty much undeniable. that policies will produce a better banking environment than you can find by going into conventional banks and trying to get deposits and loans from them. It will always do this because the entire enterprise, the entire mutual life insurance company exists to make money for you as the owner.
Are you tired of feeling like everyone has their hand in your pocket? At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to take back control by banking on yourself. Visit livingwealth.com/escape-the-bank. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even folks experienced with infinite banking often tell us they learned a ton too. So, it's worthwhile regardless of your experience level. Stop letting banks and Wall Street dictate your financial future. Again, that's livingwealth.com/escape-the-bank to gain access to the free course today. Now back to Nate and Holly.
If you go back to the year 2000 when Nelson Nash wrote his book and he compared, you could get a 5.5% CD account at a bank back in the year 2000, but the policies were growing by much more at that time. The dividends were much higher in that interest rate environment. So it was obvious that IBC produced a better result, especially because it's tax-free, whereas CDs are not. And the same thing goes in low interest rate environments. While it's true we weren't getting the same policy growth and same size dividends that Nelson Nash showed in his book, that doesn't mean that it wasn't the best banking alternative anymore, because the banking alternatives were way worse than they were at the time he wrote the book. So as interest rates go up, you will see typically loan rates follow along with Moody's corporate bond yield average. But you also see dividends change. So as interest rates go up, dividends change. As interest rates go down, dividends change. Same thing happens to loan rates. But in spite of all of that, it still is always going to be more profitable to own the bank, to be inside of a mutual life insurance company, and to experience tax-free growth than it would be to use conventional banking tools. On top of this, I thought I'd mention a couple other things that people get a bit confused about. So you have a cash value that is actually guaranteed to grow every year. And you could liken that to earning interest inside the policy. It's technically just guaranteed cash value increase. And that guaranteed cash value is going to, in pretty much every policy, certainly all the ones we write, is going to end up being much greater than your premiums paid over time. And the guaranteed cash value has nothing to do with dividends, by the way. And that's why we call it kind of like your policy grows with guaranteed cash value, or you could liken it to interest and also a dividend. What surprises people, though, is to find out that as interest rates move around in the environment, the insurance companies don't update their policies with different guaranteed values. The insurance companies are design a product and a contract based on a set of guaranteed values. Those guaranteed values don't change. What essentially is interest rate sensitive is your dividend that you receive. The dividend is very interest rate sensitive. And the reason it is not because dividends are tied to interest rates. It's just simply because the insurance company takes our money, invests it in typically interest-bearing style investments, mainly bonds, and in higher interest rates, more revenues coming in, more profits coming in, and so dividends increase. In times of lower rates, dividends decrease because they're not as profitable. But it's not because your policy is tied to a bond. It's not tied to interest rates. It is affected by changes in interest rates. The guaranteed cash value, whether interest rates are high or whether they're low, is going to be the guaranteed cash value. And they don't come out with new products all the time with different contractual language for higher guaranteed cash values. It's pretty much they come out with a product, they sell it for many years until they have to update it. That's very, very common. And so the policy interest doesn't change, but the policy dividends do as time goes on. So I hope this has been helpful about how interest rates affect you and me, affect policy at a you and me level. I wanted to make it very clear, though, that as we're in a time of volatile interest rates, be happy that you have a banking system that exists to benefit you. It doesn't exist. You're not a customer of the insurance company. You are an owner of the insurance company as policyholder. The entire enterprise exists to make you money and to preserve your capital. That's the whole reason a mutual life insurance company exists. And so we should look forward to that type of environment. I think that it just allows you to become more powerful in the world whenever you have a big pool of capital that you control and that is profiting you at all times in a tax-free environment, no matter what. So infinite banking works in low rates. It works in high rates. It is affected by rates. Dividends are affected by rates as well as your policy loan rate itself. But nonetheless, infinite banking is always going to be a better place than using policies. One caveat to this one that I forgot to mention before we close it down too, was that, as it is not unusual, just like it wasn't unusual in times of low interest rate environments that you could find money cheaper than policies, that the reality is that was the exception, not the norm. Typically speaking, life insurance policy loans are some of the cheapest money you can get in the great environment. In the artificially low rates of quantitative easing for the last 12 years, we were in an exception to the rule. In the same way, right now, you might be able to find like a 6% CD or something like that if you locked up for 5 years. Or you can find some interest-bearing accounts at banks that may offer a higher yield than the internal rate of return of a policy right now. But understand that just like the interest rates were lower than policy loan rates for a period of time, that was the exception to the rule. This is also the exception to the rule. And because interest rates can move rapidly, much faster than policies will move, you end up having this. Nelson Ness even kind of wrote about this, and it's pretty commonly known in the 1980s when interest rates skyrocketed, and you can go get CDs for like 15%, 13%, whatever it was, CD accounts in the 1980s when they were trying to stamp out inflation. That was much higher interest than what policies were earning. So you would have people borrowing money from their life insurance policies at like 7% in the 1980s to go put into CD accounts earning like 14%. And all we're trying to bring up is that was the exception to the rule. That didn't mean that infinite banking wasn't working at that time. That just simply means that, if interest rates spike, you'll get that will artificially because of the Federal Reserve, or if interest rates plummet artificially because of the Federal Reserve, you'll get into these weird scenarios that are the exception to the rule. But that's why infinite banking is always done over a long period of time. You're supposed to expect doing it over your lifetime, and over a lifetime, there's just no way that a bank can compete with what you can do with a mutual life insurance policy to solve your banking needs for the rest of your life. So I hope this has been helpful. Once again, this has been Dollars and Nonsense. If you follow the herd, you will be slaughtered. For free episode resources and transcripts, please visit livingwealth.com/E212.
Listener, one last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/escape the bank. Upon completing this course, you'll have all the information that you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/escape the bank.